Aloha, everybody. Mike Drutar, principal broker, Next Home Paradise Realty, back with another podcast. Today I have April Nelson with Homebridge Mortgage. She's going to tell us about the lending industry, lending in Hawaii, a little bit about herself, and really just a ton of information over the next half hour to an hour for you guys. So y'all already know me. You don't know April. April, tell me about yourself, how people can contact you, your history in the business, and anything else you want to tell us about yourself.
Perfect. Well, thanks for having me, Mike. I appreciate this. And I'm April Nelson with Homebridge Mortgage. We're here local in town in Kona, and I am originally from Michigan way long ago. My background is engineering, mechanical engineering, so it's been a bit of a road, but I love numbers and love people, so hopefully I'm a good help to anybody trying to purchase or refinance a home. You can contact me. I have a website online, so www.homebridge.com/April Nelson, or I'm also on Facebook as April Nelson MLO, so Mortgage Loan Originator. 808-202-3441. Phone call is easy. We are, if you're in town in Kona, call me to make an appointment, and we're right in town. I'm happy to meet, also right by the bowling alley. And finally, you can email me too, april.nelson@homebridge.com.
Awesome. So we got that out of the way. Let's dive right in. The first thing we want to talk about, everyone always, I'm sure like half your calls are, what are rates today? Where are rates going? What do you think is going to happen in the next 30 days or a year? These are kind of the general questions I think people get. Everyone seems to be super interest rate sensitive, no matter what. If it goes up an eighth of a point, they kind of, oh my gosh, an eighth of a point, even though we're in the threes. So tell us a little bit about where rates are now and where you think they're going.
Well, like you mentioned, definitely a lot of questions around that. And also, just one thing, remember when you're calling around comparing, to compare the same day, to compare the same type of product, same information, because sometimes I'll get people calling also and say, oh, well, so-and-so gave me a much lower rate, and it was a week ago before things changed, or it was with a very different scenario. So make sure you're comparing apples to apples when we talk about rates. But you're right, they're still in the mid threes, typically low threes, depending on credit score and other things. And what's been happening over the past couple of weeks and starting to look like it might be a trend is they're starting to go up a little bit more. So government's beginning to taper some of the benefits and some of the, stopping pumping so much money into the economy. So as that happens, then rates seem to react by going up a little bit. However, if you look over history, they're still historically low. So, many of us bought homes for the first time 10, 15, 20 years ago, and, we would have been ecstatic to have a rate in the 3% range. Now people are not as ecstatic to hear, 3.5%. Why can't I get, 2 something? So definitely, though, the rates are still very good. Still a great time if you haven't refinanced. Maybe you were furloughed last year and back to work now, have more steady income. It's a good time to get back to that because it is still historically low, and we do anticipate the rates to slowly creep up.
You mentioned getting the details, because that's something that you see a lot. Like everyone gets these emails, or you see advertisements, you get something in the mail, typically like Quicken Loans or something like that, and they'll have a great rate on there, but then if you read the fine print, there's like a couple points that you're purchasing. Like, it's totally misleading sometimes.
Yes.
But then people have the idea that that's what rates are, and then when they actually talk to somebody, they hear something different and they think, they know what they're doing, like these companies who put out this information, but it's kind of not.
Yes.
It's definitely not apples to apples. You really got to get the details to find out if you're actually paying that rate.
Absolutely. So paying points is one thing. You could be paying several $1,000s in points just to get a slightly lower rate. Also, if you're looking at a purchase versus a refinance, or a condo versus a house, or a credit score of 740 versus 640, VA loan versus a conventional loan, all of these things play into what the rates are. So like you said, you may see an advertised rate that's 1.78, I think I keep seeing in my Facebook feed, and it's just not very available to most people, or it just wouldn't be the smartest decision either if you're going to pay thousands and thousands to get this lower rate, but really it's going to take many, many years to pay itself off.
Right.
Maybe a rate in the threes is a better choice.
So one thing that we see happens here a lot is, and I think a lot of people know what, a primary home, for your first home mortgage is, and that's kind of the rate that you always see. It's someone's home with, good credit and a good amount down. But a lot of what we have here are investment properties or second homes. And those are two different products, right?
Yes.
And a lot of people don't realize that. Can you educate us a little bit about the difference between, a little bit about the primary home, because everyone already knows that, but the difference between an investment property and a second home and how that impacts your mortgageability and the mortgage rate that you might see on those?
Sure. So primary residence, as you mentioned, most people know what that is. It's where you're going to live. Second home and investment property, the main difference is an investment property is something you're planning to rent out. If you are not planning to rent it out and keep it just vacant while you're not there and then go vacation in it or something, then it's a second home. So one caveat to all of this, things are constantly changing. Fannie Mae, Freddie Mac are trying to cater towards people who are looking to purchase a home to live in. And so rates have been doing some interesting things where usually primary residence is a better rate. It's changed back and forth a little bit this year. So as of this publication, rates are slightly worse for a second home and then a little worse than that for an investment property. The assumption is that, you have more to put down. You have, it's not a need. It's more of an investment or a want in that case. The other thing, the big difference is that for primary residences, especially if you're talking conventional loans, you can put as little as 3% down on a primary residence, where investment properties, you usually need 20% or perhaps higher if it's something like a non-warrantable condo.
Yeah. It's really interesting. And, we saw that play out during the financial crisis, back in 2008, 9, 10, 11, 12, all the years subsequent. You could go to a condo complex like here locally, Casa de Emdico, and there was a really high rate of foreclosures and people just not paying their maintenance fees and things like that, which created more foreclosures. The easiest thing to get rid of if times are tough is that second home or that vacation home or whatever. And so that's a higher risk for the lender. So it makes sense that it should be a little bit higher. Fannie just got back into that business here recently because they had a thing where they weren't doing any, was it second homes or investment proproperties? They weren't warranting them.
They had a limit. They had a limit on how many they were taking, but they already had sold that limit. And so,
right.
Yes.
And it's a limit like per calendar year. And so then they hit it and then you're closed off for the rest of the year. Are they still doing that now? So
now they've kind of repealed that. But again, I guess I hate to say too much concrete because it's been changing so much. So It's an ever-evolving landscape. They have accepted now, going back to second home and investment properties, they are buying those again. But again, it's always changing. So hard to say, and I think some lenders still see it as a bigger risk, and so there may be an adder on your interest rate, even if Fannie and Freddie are supporting or backing those loans.
See, I kind of find that, I don't know that it's a good idea just philosophically to have Fannie and Freddie backing those loans. Like they should be, to me, backing primary homeowners loans for people, especially in this kind of a market, trying to get a house. So you could have someone who's trying to get a home to live in and to raise a family, and someone else is looking to purchase that exact same property as an investment. And now these two are both competing, and the investment property can actually, or investment purchaser can compete pretty solidly in terms of interest rates, because you're going to have a lower rate if your loan is government backed than if it's not, right? And so this investment buyer is driving out the original property owner. And I just wonder if that's really the role of Fannie and Freddie. Like they should be really promoting home ownership, not investment property ownership. That's just my opinion.
Yeah, and that's their charter, I think. I mean, that's definitely why they're making it a little bit more expensive.
Yeah.
And
it's just, the other part is just, I with the market, with the incredible increase in values that we've seen, I wonder how smart it is to add more fuel to that market. Talked with someone who's been in this stuff, who's way up in DC and has been in the past administration, and he kind of mentioned that back in the financial crisis, Fannie and Freddie did the exact opposite of what they should be doing, right? When the market was going up in 2004, 5, 6, 7, they made it easier to borrow money when they should have been, if they're doing anything, kind of tampering things down, if they're going to have a hand in the market at all. And then when it was really hard to borrow money and the market was when the market was crashing, they made it harder to borrow money. And that's the time when they should be opening up liquidity to stabilize things. Yeah. So they seem to do the exact opposite. And so when I saw that they opened it back up here earlier this year, I kind of thought, well, that's just another punch in the gut for the local family, someone who lives and works here in Hawaii trying to buy a house. Now they're competing not only with cash buyers, but actually we've unlocked other investment buyers who are borrowing and leveraging against these folks. It just seems like the odds are even stacked harder against the people who live and work here.
And similarly, on the warrantable versus non-warrantable condo discussion, Fannie and Freddie, I think, are choosing to not warrant or not back condos that seem like more vacation type properties, hotel type properties. Maybe they have some vacation rental things going on. So what happens is it makes it so no single family or no primary residents, people looking for a place to live, really can even invest in some of these condos because they can't get a loan in there. Where, I think the original charter is to make it so they are focusing on the condos that are more residential. They're trying to do that charter of focusing on people that need homes. But meanwhile, they're taking a big chunk of condos away from people who need a loan, and only investors are able to do those, or buy them with cash, or buy them with portfolio products with much higher percent down. And I understand that with some properties that are very clearly timeshare, maybe don't even have a kitchen in the unit, but other properties are actual livable condos that people could be using. But it's interesting how sometimes it's contrary to what you might think. The benefit of Fannie and Freddie trying to push one thing, and then it results in something different.
It's a good point. So tell everyone what warrantable versus non-warrantable means.
Yeah. So condos now, there are condos that are considered sort of condotels, which are more run like hotels. So often either they have like a front desk, maybe they have a share in maybe they have timeshares. They might have partial HOA that also rents out some of the units as short-term vacation rentals. Maybe they have the word resort in the name. They might even have things like units that don't have full kitchens that are more like hotel rooms, or have interior decorations that are very consistent unit to unit. But it's a very fine line. So it's a difficult gray area when you have some of these condo complexes that have some of these features, but not all of them. And people do live in them full time, but also some people rent them out short term. So if they are considered a warrantable condo, generally they're going to be more of the residential condos, and Fannie and Freddie will back them, and you can get a traditional mortgage on them. If they are not considered a warrantable condo, or they're a condotel type property, then you need to get sort of a portfolio loan or use cash. It's much harder to get lending on them. And the idea is that they're not as appropriate necessarily for a primary residence.
We run into that quite a bit, the warrantable, non-warrantable thing, and it's kind of an inside thing, and so people often are like, what is going on? Because it doesn't make a lot of sense to people. Okay, so let's move on our discussion a little bit. Banks versus lenders versus brokers. So there's different types of places that you can go to borrow money for a refinance or a purchase. Tell everyone what's the difference and some of the pros and cons and where you fit in on that.
Yep, sure. So I think a lot of people think of their banks, maybe they have Wells Fargo or something. Very common to call them up and say, hey, I want to get pre-qualified for a house. Banks lend money, but they also do banking, checking, savings, credit cards, sometimes other products. Lenders focus only on mortgages. So they generally will do many of the same things that banks do, but are very focused on mortgages, so may have more knowledge about a lot more mortgage products. They may also be much more focused working together with realtors and things because it is their primary focus. Banks sit sort of more on the side. And then brokers, mortgage brokers, are kind of like a middleman, and they may have access to many different lending products with many different lenders, and they can find kind of the best one for you. They're also a middleman, so they're going to have some markups, and they may not be as familiar with some of the products because they're not right in the trenches of doing it. And they may also have a little bit slower reaction time because they do have to kind of go back and forth with some of the lenders. Homebridge is a lender, so we do our own loans, but we also can broker loans. So when there are some very unique situations or specific products or things like condotels, then we may broker those out as well. So you get a little bit of the best of both worlds, where I'm very focused just on mortgages. So if you have mortgage questions, if you need a little bit more hand-holding or have a much more difficult situation or scenario, and maybe a bank has denied you or someone else has said that you wouldn't be able to get a loan, it's worth a call. So I may have a product that might be able to work, or I may have a broker partner that we work with that has something available.
There's some real challenges because, for me, dealing with hundreds of transactions now that have had loans, I've seen all three models and how they play out and the pros and cons of them. And the bank, and for anyone who's watching, listening, who is part of a bank, this isn't anything, I'm just giving you my opinion. It can be a really tough process because, like you said, it's just not their core competency. It's not the focus of their business. Their systems aren't set up to be optimally run. They're if they do a bad loan or if they make a bad customer experience on on a loan, they're still fine because they're doing banking and checking and all these other things. So it's just, I don't see the level of service, and especially, and one of the things I really love about what you do, the level of communication is really tough. And so, like, as a real estate agent, if I write a contract and I have a bank as the person who's financing this, like my seller or my buyer client says, no, I'm working with bank X. Here locally, if we have a contract that's less than 60 days, they're like, we can't do it. So they're that much longer, just right off the bat, longer period of time to work with. And in a competitive market, that can actually be a deal killer for the seller. They're looking at 6 or 7 offers, and you've got a financed offer that can close in 45 days, but your financed offer through a bank has to close in 60 days. You might just go right to the rubbish bin right off the bat. So that's the frustrating part about working with the banks. The mortgage brokers do a pretty good job, I think, but the problem is the layer of communication. There's that additional barrier there to know exactly what's going on. And so that's what I really like about what Homebridge does as a lender is the communication on both of those other systems is the problem, and that's where you guys solve it. And for me and my clients, what's most important for me is that my clients have a good experience. And I can let them know, listen, this isn't 2004 again, okay, where you could just fill out a piece of paper and get a loan. They're going to check you out, and it's going to be time consuming. But having someone who's going to communicate with you is really the difference between having a good experience and a negative experience. And so that's what I like about what you guys do and your model is that it puts you in direct, we partner together. We'll be on emails with you and me and the client. And we'll all three be in that chain. There's not another leg out to the actual lender, or it's not getting not answered in 4 or 5 days like it can with the bank. And I'm not trying to diss them. It's just my experience has been that lenders are often really the best way to go. So that's why why I had you here is because I think that's really the difference is that personal touch, and that's what I like about it so much.
Great. Well, thank you for that. I mean, what's your experience with weekend help as well? It seems like a lot of real estate deals go down on the weekends, and that's when people are available to look at homes and write offers and all of that.
So with a bank, we'll just set that aside. You're not going to get anything. You'll get nothing. You're not. I don't even know if those folks have access to the bank email on the weekends at home. Maybe they do, but you won't get anything there. Mortgage brokers, you'll get some information, but again, that layer of communication. So now you're having to go through 2 people on a Saturday or a Sunday to talk to. So it's just
So you might get an email that says something like, "Oh, I'll follow up, but I might not be able to get back to you on Monday."
Yeah, and like I need a pre-qualification letter or whatever right now for this amount. So like usually with most of my clients, I tell them, you need to call April now, and you need to start go on this process so that when we find the house for you in another week or so, she can actually write up the letter, and it goes with the offer. But you have to get in front of it. You can't just call someone on a Friday, say, hey, we're writing an offer today, let's get a pre-approval letter. It's just not going to work. But if we've already done that work, and I can just text you on a Saturday, say, hey, this is the property and these are the numbers, and you already know it works, and I can get a letter from you, and then we attach it to your offer and we move forward. That helps us, it just checks a box. Because with the sellers, sometimes there's so many offers. It's like when a buyer is looking at a property in a down market, and there's 30 houses to look at. The first thing they do, they're like, let's get this to a manageable number. So they just start throwing out houses. 2 bedrooms, it's out. No yard, it's out. No view, it's out. Well, it's the same for the sellers right now. If they have a whole bunch of offers, no pre-approval letter, it's out. And so that's just one thing that can get in the way. So you absolutely, in this kind of a market, have to have that lined up ahead of time. So again,
Well,
the
and when you
communication.
mention that, no pre-approval letter out, I'm also hearing sometimes not a local lender out, or somebody who doesn't understand Hawaii.
Yep. In particular, the banks, the bank lenders. I don't know if I'm advising a seller client who has many offers, and I have a local bank, or any bank really. It's not just local banks, and I know it's a 60-day contract. It's just things can change. Interest rates can change. The ability of the buyer to buy can change because you have a longer amount of time. Interest rates could go up a half a point. That's happened to me in the past with my buyer clients, where the time it took for the house to get built, the market changed so much with lending that they could no longer buy the property. So that time can be a problem. So that's an issue in there. You got to take it all into account. Okay, let's talk about some local Hawaii things. Hawaii has some interesting situations because we have lava zones. Lava zones have, depending on the lava risk zone you are in, it can close off different loans to you, or even the ability to get a loan. Talk a little bit about that.
Yes. So Big Island has lava zones 1 through 9, and 1 is the highest risk and 9 is the lowest risk. Generally, zones 3 through 9 are lendable. Pretty much any product, conventional, VA, FHA, USDA, all of these will lend in zones 3 and higher. Lava Zone 2 generally has less expensive real estate, and so there is a need for people to be able to get mortgages in these areas. You can get insurance, but it's more expensive in Lava Zone 2. And so there are some conventional loan programs that'll do Lava Zone 2, and VA will still do Lava Zone 2. USDA was doing Lava Zone 2, and now they are not. Recently, they changed that, so now it's Lava Zone 3. However, as I mentioned, things are always changing. And so at Homebridge, we have a pretty large team that goes with all the bureaus, and USDA in this case. We're working with them to kind of help make a case for, hey, there are people who really need a home, and if it's a choice between buying something unpermitted or renting or living in a car or something versus being able to afford something in a Lava Zone 2, let's help make this happen. That USDA loans have zero down and they have income limits and things, but they definitely help people get into homes that might not be able to afford it on a conventional route. So not to go too off on a sidebar, but lava zones are pretty important here. So there are certain programs that will do Lava Zone 2, others that won't. Lava Zone 1, most will not. So you really have a hard time getting any lending in Lava Zone 2, and most of that is because you can't get insurance very easily in Lava Zone 1, sorry.
Mm-hmm. Yeah, and you mentioned it, some of the most attainable real estate on the island happens to be in Lava Zone 2, right? And so we see it here on this side of the island down in South Kona, Ocean View, and those sorts of areas that are primarily Lava Zone 2. Mm-hmm. So it's just something you have to take into account because it looks cheaper, and it will still be cheaper in the long run, but your cost of borrowing and your cost of insuring is going to be higher. So you have to kind of take that into account, especially if the numbers are getting pretty tight on your pre-qualification letter. Property taxes. So we have really low property taxes here on Hawaii Island, and it's because our school system is actually administered at the state. So your state general excise tax and income tax are what fund that instead of your county property taxes. But what we have that's unique is that we have more than two, but generally two property tax rate classes: homeowners, owner occupants versus non-owner occupants. And you can have double or even more tax if you're not an owner occupant. So you can take that into account when you're buying your property and like, okay, this is what my tax will be. But the funny thing is, the seller's tax matters, doesn't it?
Yes. So for lending, for qualification, we take the current tax rate. So in many markets, that makes sense. Whatever the current tax rate is going to be close to what you would be paying. Here, if the current taxpayer or the seller is a homeowner and they have the homeowner's exemption, they might have a much lower tax than what you would be paying if you were buying as an investment property. Or vice versa, if they own it as an investment property and they're paying a much higher tax, they don't get the homeowner's exemption, they're paying almost double the tax rate, then you have to qualify with that tax rate. But when you put your homeowner's exemption, if you're buying it as a primary residence, then next year your tax should go down by quite a bit But if you find a house that has that higher tax rate, that's what the lender is looking at, unfortunately.
And so that can be a couple $100 a month. And so that
Yes,
really,
even more in some cases. Yeah, it could be from $250 a month to $600 a month or something on property taxes if it's a different class.
Right. And so that affects how much money that you can borrow, because the amount you can borrow is based on a debt to income ratio, and they just have to account for that.
Yes.
And at current tax rates, I haven't checked this in a few months, but every $100,000 you borrow is about $400 in mortgage. Is that about right?
So there's I'm not sure what you mean.
So like if I say I want to borrow $100,000, how much does that cost me a month?
Oh, for a mortgage payment or something like that? Yeah, like principal and interest, you mean? Oh, okay. Roughly, yeah.
Yeah, roughly around 400. But then you can reverse engineer that. So if I have to spend an extra $400 a month on this house because of taxes, I've lost $100,000 in borrowing ability.
Exactly.
So you can have two houses, or let's go with two condos. We got two Kona Sea Ridge condos, exact same assessed value. They sell for the exact same prices right next to each other, sharing a wall. This one might cost you more because of the situation of the seller than this one in terms of your mortgage payment calculation for that first year.
You might qualify for this one and not qualify for this one, even though everything else is the same.
Right. And even though your situation is the same, because we don't, here in Hawaii, the tax doesn't change until I think every 6 months, or is it just the first of the year? But every 6 months, I think, that you can actually have the tax status changed to your situation. So you'll get your money back. There's an impound account and all that kind of stuff. The numbers will work out, and as long as you file everything, that's fine.
That's the key too. Remember to file your homeowner's exemption. If you don't, you won't get the lower rate.
And there are no exceptions to that.
Yes.
Like if you're a day late, they just say no. Try it. You can go ahead and file it now.
Can't go back and get it back.
Yeah, we'll get it for you in the next 6 month
Yep.
change. So that's really important on the property taxes. We have a lot of places here that have unpermitted additions. It's really common here with the slope that we have on Hawaii Island. Sometimes people will build on post and pier, and then later on when the family grows or they need some extra money, they can rent out the bottom. They'll go in and close it and finish it, often in a workmanlike manner, but not necessarily with any permits. So how does that affect the lending of a property? If I'm going to go buy a property that maybe has a downstairs living area, and it has a living space, it has a bathroom, it may or may not have a cooking surface, definitely has a sink. How does that affect the lending process if it wasn't permitted?
So there's a lot of tails to that, and it depends on the lending product too. So if you're a VA loan, unpermitted or USDA, very hard to do. But if you're on a conventional loan, if you have a small unpermitted area, maybe like you said, an enclosed something that used to be a garage and it was changed into something livable, or somebody added a lanai on the back, unpermitted. Usually then the appraiser can just ignore those unpermitted areas and not include them in the value of the home. So as long as the home appraises for the value on the purchase contract, then it's usually okay, as long as they were done in a workmanlike manner and not causing safety issues at the home. If it's a much larger thing, like most of the house is unpermitted or all of the house is unpermitted, or there's a completely unpermitted ohana or something like that, then you can run into issues beyond just the appraisal side. We cannot lend on an unpermitted house, a completely unpermitted house. You can't get insurance typically on those kinds of structures either, so it's kind of more of a cash situation. But if it's a small unpermitted something, they added a bedroom, added a lanai, added somewhat of an enclosed downstairs. I mean, it just depends the extent of how much unpermitted work there is. So
right.
It is possible.
It happens a lot here, and for me, the challenge, if you're someone who's trying to come in with that 3% down payment, it's going to be tough, because the seller wants full market value, and in this market, they can get it as though it's been permitted. The appraiser can't count it at all. It's as though it doesn't exist usually.
Right.
And then if they have a second cooking area, and this gets into zoning a little bit, if they have a second, here in Hawaii County, if it's usually zoned single family residential, but they'll build this area underneath, and they'll put in a sink and a stove. And once you put in a stove or a microwave or a hot plate, or even a toaster, I've heard, any cooking surface or item, it then makes it a kitchen, and a second kitchen makes it multifamily, which is not zoned for, so now you got a zoning problem.
Yes.
What other zoning problems or issues do you see, or how else does zoning play into the lending process?
That is the key one. A lot of times, especially even on refinances, we'll see where somebody's turned it into kind of a more than one unit for tenants and things. They have to remove that stove to be able to get the appraisal written off, everything correct. Remove the stove, cap the gas line if there's a gas line, and then we can move forward with lending. What they do after closing, we don't know if they put it back, but it has to comply with that, with the single family zoning that it's in. So definitely the stove is the big one that happens a lot here.
It's interesting because, we see a lot of these houses that are clearly zoning violations, but thankfully the County of Hawaii doesn't really go after these. They kind of turn a blind eye to it because unfortunately, that makes up a lot of the workforce housing that we have. Like a lot of our rentals for people who are here long term are these types of unpermitted structures. And if you took them away, like if they actually, said everyone who has this, it's a red tag and you can't rent, we'd have an even worse housing problem.
A huge crisis, yes.
Yeah, than we have already, which we absolutely have. Okay, so let's talk a little bit about the mortgage industry and just the big picture, because like a lot of other industries, there are big changes. There's so much consolidation in industries across the board, and real estate has really been a big target. Lending's been a big target. There's a lot of dollars involved in these transactions, and so obviously there's a lot of interest of getting involved in that business. Talk a little bit about what you're seeing overall on the lending business.
Oh, there's so many changes. So last year was a big boom. This year too, with a lot of refinances and things. So we did see a lot of hiring and a lot of people getting into the business. A lot of people getting licensed in multiple states. So as a mortgage lender, you get licensed by state. You take a national test and get licensed that way. But I'm licensed in Hawaii, for example. So I can do loans in all of Hawaii, but I cannot do them in other states. We saw a lot of people getting licensed in other states, like Hawaii, for example, that's had a lot of growth. And then now we're starting to see signs of some of that slowdown happening. And so we're starting to see people who got into the big boom time, some of the lenders might be struggling a little bit, looking at being more efficient, layoffs may be happening. But also just consolidation, like you mentioned, lots of changes. Everybody's trying to get into the business. So we're seeing some real estate companies also try to bring lending under their belt, and vertical integration is a thing that people are looking at. And then on the flip side, people look at outsourcing again too to try to promote more competition. There's just all kinds of changes. But I would say the biggest change right now that we're seeing is technology. More and more things are happening online. More and more things are happening remotely. Things like cryptocurrency, Bitcoin are starting to be accepted as forms of payment in your mortgage loan or forms of down payment.
Oh, wow.
We're seeing a lot of changes on the technology side. So even Homebridge announced a merger with Figure, and that involves some blockchain technology. And without getting too much into the weeds on that, a lot of lenders are working on getting better online, better security, better options for people to do things remotely. So I think the technology piece will continue pushing us forward.
The vertical integration, you talk about that, and for me, when I look at it, it doesn't make sense. I get it from the company's perspective because there's more dollars there, and let's get more of the dollars, right? But if you were a vertically integrated company with one of my competition, for me, my competition can't be my vendor, right? It just can't. And so if you're part of ABC Real Estate that has ABC mortgages as well, that's great. You'll do all your work. You can do your work with them. But for me, and I think a lot of other business owners, I wouldn't be comfortable just referring my business to that same lender who has such a tight relationship with some other real estate company.
Right. Who might be even sitting in a cube next to
in the
somebody
same
else,
spot.
right?
Yeah. So, and I keep seeing all this, but I just don't know how boots on the ground that really works long term. Like I think, if you were to do that, I think your business would suffer greatly because a lot of the other agents wouldn't want to work with you, or would be concerned about it. Whereas here, like you work with me, you work with people, every real estate company here in town, everyone's okay with that because, what I tell you is between us and what they tell you is between y'all, and, it's fine. But yeah, if they're having a cubicle right next to my competition, who may even be on the other side of the transaction from me, that gets really uncomfortable. So it seems like they do it, and it's usually these larger companies. Sometimes they're publicly traded, or subsidiaries of publicly traded companies. So they do it to make the stock, the owners happy, and maybe raise the stock price. And then usually in 2 or 3 years, you see that they spun it off, and now we're going to focus on our core competency. And then 10 years later, they'll bring it back in again. It's just sort of
pendulum swings back and forth. On those things.
It's kind of interesting that we still see that going on. We have on here home buyer trends. Talk about some of this. You have a few things on the list here. I'm really interested in hearing about, because I think you know a heck of a lot more about that than I do.
Yeah, well, I would say definitely we've seen a lot of investors here in Hawaii, a lot of cash buyers also. So, any statistics I see, it seems to hover around 50% cash buyers versus, people getting loans. But as far as different groups, I would say nationally, people are focusing a lot on millennials. I don't see that as much here in Hawaii. I think partly because price is a barrier to entry here as well.
I agree.
And then the industries that we have here as well. But women as buyers or home buyers have become kind of a larger group to focus on for a lot of lenders. And, for me, I bought my first house in my 20s. I, always worked really hard, saved a lot of money. But I think now there's even less barriers to entry, I guess. Now we have COVID, which put work from home at the forefront for a lot of people, and a lot of companies got okay with sort of the flexible work hours. Working from home makes it easier for families. So women who may have kids or maybe are, single parents, things like that, have more opportunity to purchase homes because they maybe have better employment that's a little bit more flexible and accommodating, and then also work from anywhere, live anywhere kind of post-COVID idea. So maybe they can live somewhere further out of town that's less expensive, or maybe they can live somewhere closer to other family and relatives and things. So not to stereotype too much, but I think in general too, what I see a lot, just anecdotally, is that even in couples, more often the woman is the one filling out all the paperwork, doing a lot of the things, not always, but quite often. But I think some of them may get frustrated that usually it's the man's name that's first on the deed or on the title or on the loan. One of my friends actually recently posted something about that, just from her own experience. We weren't talking about it, but I guess for me, I've always had kind of a focus on both, but I see women as kind of an increasing group of home buyers that also may be more excited to have their name be first if they're doing all the paperwork or things like that. It's going to be an interesting one. I think a lot of things post-COVID have changed a little bit of the landscape on work and where people can live and all of that can help, I guess, push that, some of these groups, even multi-generational households too. We're seeing more of that here in Hawaii, especially because the prices are rising. So in order to be able to afford it, we bring all of the family in, and we can do 4, 6, 8 people on a loan if we have to, if they want to qualify for a more expensive house.
The multi-generational thing is kind of interesting because it's happening everywhere. So I've gone and looked at houses in other cities on the mainland and look at new construction, and the builders are building multi-generational homes.
Interesting.
Like in Phoenix or Vegas, they'll call it a casita, but it's attached. Somewhat, but it's definitely separate.
Yeah.
And it'll have its own living space, its own bathroom space, its own cooking space. Like it's zoned to allow for a second kitchen in there.
Oh, wow.
And so like if you can have, an older parent, or, a younger adult child, something like that. I mean, we're building houses for that now. I think it's been in Hawaii for a long time. But sort of in that add-on sort of way, not necessarily designing houses like that, but building houses like that. And, you saw that if you go back back east, you go up in Vermont or Maine or something like that, you'll see houses that have, here was the house, and then they built on, and then they built on, and then they built on as the family grew and more. I mean, it's actually pretty common.
See that here too, right?
But it's happening. It happens here a lot, and now it's just all the numbers that are involved in things. Might have been different back then. Maybe it was because they were all working on a farm or whatever. But now it's just the numbers make it kind of necessary sometimes, because we just haven't. Here in Hawaii, we have not built homes. We have a very strong contingent of people that want no development. And you can have whatever opinion you want on development or not, but the bottom line is, if you don't build homes for people, and there are going to be more people, then the prices are going to go up. It's just supply and demand. It's super uncomplex. Yes. And so we're just seeing prices go crazy, and so you're going to see more of the multi-generational stuff, I think, come up, because like right now, I can't find a lot. I think there's one for $250,000 in Kona that just came on the market today. That's going to need some work. It's like a 9,000 square foot lot, but you can't find lots for much under $300,000 right now.
Yes.
So that's just the land, and then the building costs here are pretty high. So the multi-generational thing is going to be good, and it's going to be a lot easier to build a little bit of an addition onto an existing home than just building a home. And so I think that's going to be huge here. It's going to continue to grow.
And even on that same token, that's why you see a lot of these homes divided. Okay, if you can put in a door here, if you can separate the upstairs and the downstairs, if you can separate the back from the front. Not only multi-generational, so people can afford it, but also just for rental income, or helping offset some of the mortgage costs. They might rent it out to a tenant, or they might rent out as a vacation rental part of the home. So it's getting more and more common to see that.
You mentioned we don't have many millennials here. I totally agree. The prices and lack of good paying jobs make it pretty tough for someone who's starting off. First-time home buyers I see just really having a tough time out here. The few first-time home buyers that I've worked with here, surprisingly, are not people who went to college. They went to trade schools, and it's really good to see that. Like, everyone tells you have to go to college. These guys went to trade schools, and they're in their 30s, and they're doing great.
As a sidebar on that, that's what I'm seeing also, is the most important thing is not intelligence, is not education, it is self-discipline. I don't know if you've heard of the marshmallow test for kids, where they put a marshmallow in front of a kid, young child, and say, okay, I'm going to walk away and do something, and when I come back, if you haven't eaten this marshmallow, then you get 2. Otherwise, you can eat the 1 marshmallow and get the 1 marshmallow. So they walk away, and if the kid has eaten the marshmallow, they've kind of done a lot of different anecdotal studies too on this, but then that child is maybe less likely to succeed in the future, or save, or be self-disciplined. And if they wait and they get their 2 marshmallows, then it translates in the future to saving, not buying all those new clothes or expensive toys or iPhones or whatever, and saving the money, save, then they're more likely to have a down payment for a house, and more likely to succeed in some of those areas, like the first-time home buyers, have better credit, things like that play in huge if you want to get into the housing market. And then once you get in, then stepping up is much easier.
I think if that's a good, I love that story and that little test, the marshmallow test. I would fail it until I hit about 30 years old, and then I would have passed it. But I would have definitely failed that as a kid. I would have taken the marshmallow and
Ate
just
it immediately.
ate it immediately. Maybe it's trust issues. Who knows? But I would have taken the marshmallow. But I think I was a little bit of a late bloomer. I think I learned later on that. Okay, we have some stats. Oh my gosh, this is a 143-page report. This is publicly available. I'll leave a link in the description here for the video, or if you're listening to this, I'll have a link as well. 2021 Home Buyers and Seller Generational Trends Report. It's 143 pages put out by the National Association of Realtors. Boy, there is a ton on here. Characteristics of home buyers, of homes purchased, the search process. I am just now opening this document for the first time, and I'm kind of surprised it's this robust. Have you looked through this yet?
Yeah, so it is. I just want to note too. It's published in March, so it's at this time about 6 months old or so, or 7, I guess, months at this time. But if you're into statistics, if you're into details, if you're just curious, there's a whole lot of good information about all the different categories of home buyers, and everything and anything, like you mentioned. It's a very long document, but there's a lot of great charts too. So if you just like to skim through and look at visuals, it's a neat document. I like data. I'm a data person. So
I'm with you. I'm geeking out just watching it right now. So page 7, share of buyers and sellers by generation. Generational trends are super important because we have a funny, if you were to look at the size of our generations and how they work out and the buying power, it's a funny double hump that we have. So you have your older boomers and your younger boomers. So let's see here. Older boomers are selling and not buying as much. That makes sense. Younger boomers also selling and not buying as much, but at a less disparity on there. Gen Xers, that's my generation, all 12 of us. We're a small group, about equal and making up a quarter of the market of buyers and sellers. And then, of course, your millennials. Older millennials are 23% of the buyers and 18% of the sellers. Younger millennials are 14% of the buyers and only 4% of the sellers, which makes sense. They haven't bought yet, so they can't sell. And actually, Gen Z is popping up here on the market now at 2% of buyers and sellers. So that's interesting to see them already in here. Mm-hmm. It's going to be interesting to see what happens with older boomers and then the silent generation, and to some extent younger boomers, as they move on and their assets pass to the millennials and the Gen Zs and a few of us Gen Xers, how that changes the buying power. As a Gen Xer, I do worry that we're going to be skipped over again.
Miss out on that.
Yeah, we're the middle child of generations.
That's all right. We can make it happen for ourselves. We grew up in a hard-working time, right?
Yeah, we're fiercely independent. Yeah, a lot of good data on here. I'm going to look at this more later, and again, I'll have, like I said, the link to this report down below because there's a ton in here. Anything else you want to talk about with lending?
I guess I would just say, when we talk about all the different types of lenders and things, for me, the focus is, even if you would have failed the marshmallow test, or if you do today, I really like helping people getting involved in getting them to that end goal of buying a house or trying to be a first-time home buyer. So it's never too early to call if you're just thinking about it. We can always go through the numbers and maybe not pull credit right away and just kind of talk about the situation. Here's what you need to save. Here's what you need to do to be in a good position. Maybe you need to pay off this car or work on your credit here or there. I think, for me, I like to be kind of like a mortgage friend. Somebody you can call up and just ask questions, try to figure out how you can make this happen. There's a lot of creative things that we can do, a lot of different loan products out there too. So anybody who's kind of looking at the first step even of getting into a home or trying to buy a home for the first time, even if it's, you've rented for 50 years and you want to get into a home, I have people that call and we're able to make it happen. So I really, I enjoy talking to people. Reach out. I'm happy to help no matter what stage you're at, if you're ready to buy today or if you're looking to buy in a couple of years.
I'm glad to hear you say that because I'll tell you, like for me personally, between 2008, 2011, life kicked me in the teeth. And like my credit was bad. I mean, if I went into all the details, it wasn't good. And the thing is that doesn't have to be what your future is also. But it takes work and discipline, and you have to make some choices, and you have to make some sacrifices, and then you can get back to where you need to be. Mm-hmm. For me, for what I see so much, a lot of times is just living with a little bit less. Like, if you have a car that's paid off, do you need to go get another car? Like, if you just had that extra $500 a month, whatever your car payment is, to get rid of other debt problems that you may have, student loans, just things that are outstanding that are hanging out there. You can just get rid of all those things and those negative things on your credit. It goes so far. Mm-hmm. But you have to make those choices that are tough choices you have to,
Needs versus wants, right?
yeah, you got to focus on, you got to hunker down. And I don't think we all do a really good job, many of us, at sacrificing. Our society doesn't really, I think, promote that. It promotes, living large. And I think that, what I see, and the part that's heartbreaking for me is seeing other people my age and, younger, anyone 30 plus, who's just not even on a path like to home ownership. And I'm really pro home ownership because I think this, if nothing else, you can buy your home, you can lock in your rate, your mortgage payment for the next 30 years. And chances are you'll be making more in 10 and 20 years down the road than you are now, but your mortgage is the same. And after 30 years, you're done, and you could retire. Like, you can live your life without having to rely on others or anything like that. So, or without having to work until you die because you have to pay rent. But
especially here where rents are higher than a mortgage payment in most cases. So if we see so many people struggling to find a rental, and they're offering to pay more than what you'd pay on a mortgage payment. Maybe they have pets and they can't find anything, or the owners are selling and they have to move every 6 months because their unit is not available anymore. Getting into a home, you may be saving money and that peace of mind knowing that you're not going to get kicked out of your rental and the next time the lease is up is just huge for a lot of people here.
I remember working with some people back around the 2010 through 2013 range when prices were really low. Like, we would look at houses, a full house here in Kona, and they'd walk away from a deal over $5,000 or $10,000, and we're talking $320,000. But then here we are a few years, 10 years later, and they're spending $4,000 a month on rent, and there's now they look at the prices and it's not attainable anymore. Like, they've missed it. And if you're in your 50s, it's like, what's your plan here? So I really think it's important to have someone to talk to, and so it's good that you guys do that. I'm sure there's credit services around here that people can work with as well, and to kind of get things in line. But I think it can all work out. It's not as hard as people think. You have to make some sacrifices and stuff, but I'm literally proof that you can do that and then come out on the other end. And now it's 10 years later, and I can remember that stuff, but just barely.
Well, I just helped somebody who is buying his first home right now. He's in his 50s. He's always rented, grew up on Kauai, rented his whole life, and never thought he could even own something. And he's had a steady job, but he also had child support and other things for a long time. And as that's ending, it was just positioning it right, and then the right condo came available, and now this peace of mind for retirement is okay. If I'm on Social Security, I'm not going to have to work until I die. His father's in his 70s, almost 80 years old, and is still driving taxi and working. The planning for that future time when you actually will be able to take a little bit of retirement or work a little bit for fun, but not have to feel like I don't know where I'm going to be laying my head down at night kind of thing, or be able to afford it. It's possible for anybody. The best time to buy is 10 years ago. The next best time to buy is now. And even on the debt side, like you talked about, if you do own your home, cash out, refinance to pay off other debts is still a great opportunity too for debt consolidation. So circling back a little bit to interest rates, even if you get 3.5 now, and it's not saving you much on your house payment, if you can pay off credit card debt that's maybe 15%, student loans that might be 6%, something, pay off all those things, have one house payment, and keep it at a fixed rate of 3.5%, or even 4%. Even if it's 4%, it's lower than all of these other things. You can be in a better position too for the future. So I'm happy to help with that sort of financial planning aspect too.
And at current inflation rates of 5.4%, you're actually essentially being given money to borrow. To borrow money. You're getting money to borrow money, so it works out. Okay, well, this has been a good hour. I thank you again, April Nelson with Homebridge. I'll put all of your information down in the description, so if you guys want to reach out to April, she does a great job. I highly recommend her, and her communication is really what sets you apart from a lot of the other folks here on the island. And I've had a pleasure working with you a number of times, and we'll keep doing it in the future. That's all we have. I'm Mike Drutar. Thanks for joining us, and we'll see you again real soon.
Thank you, Mike.